Join us now on the markets, Megan Horneman, Verdence Capital Advisors Chief Investment Officer. She's really put me in a bad mood today. Megan, that's quite a fact that not a single Russell 1000, 2500, or 2000, not a single market cap of any stock do you have an earnings yield above the 5-year Treasury yield. And that's when you like to buy. That's usually when you like to buy stocks, right? So either there's a problem with what we're assuming about earnings going up 15%, or with interest rates coming down. Because if things stay just the way it is, 24 times earnings, there's the Houston, we have a problem next year. Right?
Yes, yeah, absolutely. It's a concern that we have for the market because it's spread now beyond that, tech and Russell 1000 growth that we saw for most of the year. But now looking at the indices, not every single stock, but just looking at the indices themselves. Okay. Yes. And then the indices themselves, not one of them has an earnings yield that is above the 5-year Treasury. So It's telling you that bonds look cheap compared to equities. But we think this is just more of this euphoria that's driven all of the U.S. market caps higher this year after the election.
Yeah, that didn't sound right, the 20, but that's what it says in the notes there. So you're talking the indices themselves. So you are a long-term investor. You have to be, obviously. Would you not commit any new funds to the S&P 500 right now at 24 times next year's earnings?
No, not right now. That's just too stretched in our opinion, given the fact that the economy is going to slow. There's a lot of uncertainty, especially with the news that came out this morning with the Trump tariffs next year. The consumer continues to be very stretched. And we just think that earnings growth is way too optimistic for next year. 15% earnings growth year over year in an environment where the economy is expected to slow from this year's pace. That's just way too optimistic. We think some of this euphoria has just carried on after the election. I mean, we think going into next year, it's going to be a bumpier road. And that's where we want to go in having some dry powder, looking to rebalance the portfolios where we need to, and then have money sitting on the sidelines to put to work.
We hear the consumer's fine. We keep hearing that. But, I mean, you do point out about credit card debt, record high. Credit card rates are high. I saw about car loans. Almost many car loans are underwater, and the car's worth a lot less than what's left to pay on the loans. Do you see other signs of stress in the consumer area?
Confidence has been very, mixed. We've had maybe a good month of confidence and then a couple bad months of confidence. But, we keep hearing the consumers fine. But are they really fine? Because we also are hearing that they're changing the way that they spend money. They're being more cautious on how they spend money. That doesn't necessarily tell me that the consumer is really that strong. We think that next year is just going to be a time when the consumers really just tapped out. And there's so much uncertainty, especially around the taxes at the end of next year, that we think the consumer is going to be what's really one of the biggest risks for the economy.
I haven't heard anyone say stagflation, and we kind of put that to bed. And anyone who's predicting it, people are sort of looking back and saying you were dead wrong. But I mean, the 10-year is 4.28 today. You think maybe there is some slowing in the economy, right? And inflation is going to stay stubbornly high. It's not stagflation, but both of those metrics are headed in the wrong direction for what's really good for the stock market.
That's right. And I think it's a little early to use that word, but it is. Both of these things are, inflation is sticky in many areas of the economy. We'll get the Fed minutes today. Let's see if they have any more information about that inflation, because they did slightly alter their statement at the last meeting. And then with growth slowing. Now, we're not saying it's going negative at this time, but growth is slowing. So the Fed's got to make some comments about inflation. They've got to change that rhetoric around the interest rates for next year.
If I were the president-elect, I would be somewhat concerned. Plus, depending on how you date when a president comes in. Last time Trump came in, between November and January, when he was actually inaugurated, the market went crazy. But when people look back and grade how the stock market did, they don't start till January 21st. So he's not getting any of this right now, and maybe it is.
He will.
Maybe it is. They don't do it that way.
No, but we
Well, it's at 24 times earnings, and I wouldn't want to be taking over at 24 times.
Your point.
I wouldn't want to be taking over at 20. You know, that is a difficult. I'd rather be Obama than take over after the S&P was down 50%. Wouldn't that be better?
It definitely, when you go back in history and look at the returns just by president, it does seem better, you know, being an Obama situation. And that's why we just use history as a guide, because elections happen every 4 years. And typically, when you look at a recession, that tends to happen every 4 to 5 years as well. So there's plenty of presidents that can come in and benefit.
No, the Fed has cured recessions now, Megan. That's what we were talking about that yesterday with QE. And everything, zero, ZERP, and everything else. There are no business cycles anymore. Everything's always going to be great.